Welcome to today's deep dive. We are really thrilled to have you with us because today we're tackling a topic that honestly, it sounds like it belongs in a sci-fi novel.
It really does.
But it is currently driving absolutely massive multi-billion-dollar movements in the financial markets right now. We are talking about the wild, highly speculative world of quantum computing stocks.
It is a genuinely fascinating space to watch. We're seeing this profound collision between cutting-edge theoretical physics and everyday Wall Street speculation, and the results are pretty volatile.
Highly volatile. And our mission for you today is to cut through the intense, sometimes deafening hype surrounding this technology. We want to answer the big question. Is this a golden opportunity to get in on the ground floor of the next tech revolution, or are we looking at a massive, incredibly expensive bubble? And to figure that out, we've brought together a really diverse stack of sources for this deep dive. We're looking at highly debated Reddit investing threads, in-depth financial analyses from The Motley Fool, a comprehensive quantum technology monitor report from McKinsey, and even some pretty dense academic papers detailing quantum applications in finance.
It's the perfect mix of materials to get a balanced view. You have the raw, unfiltered sentiment of retail investors trying to find the next big thing, sitting right alongside the rigorous long-term projections of global consulting firms and academics.
Yeah.
My goal today is to help separate the speculative, pure-play gambles from the actual cash-generating technology giants that are quietly building the infrastructure of tomorrow.
Okay, let's unpack this because there is a massive difference between a world-changing technology and a profitable business. We see that mistake made all the time.
All the time.
But before we get to the harsh business realities, we need to understand the hype. Why are investors practically drooling over quantum computing right now?
Well, the hype exists because the theoretical ceiling for this technology is staggeringly high. If we look at the McKinsey data from our sources, they project that quantum computing could generate between $0.9 trillion and $2 trillion in economic value by 2035.
Trillions, with a T.
With a T, it's not just a faster microchip. That is an entirely new paradigm of computational power.
That is a number so big it almost loses meaning. Let's ground that for the listener.
Yeah.
What does a quantum computer actually do that makes it so much more valuable than, say, my laptop or even a regular room-sized supercomputer?
It comes down to how they process information. Standard computers, even the absolute most powerful ones today, use bits. A bit is basically a tiny switch that can be either on or off, a 1 or a 0.
Right.
Quantum computers use qubits. Because of the bizarre rules of quantum mechanics, a qubit can exist as a 1, a 0, or both at the same time.
Like a coin that is spinning in the air, rather than one just sitting on a table showing heads or tails.
That is a brilliant way to picture it. While the coin is spinning, it represents multiple states simultaneously. This means a quantum computer can explore millions of potential solutions to a complex problem all at once, whereas a classical computer has to try them one by one, sequentially.
So it's not just faster, it's a completely different way of solving problems. The academic sources focus heavily on what this means for the financial sector. Why do banks care so much about spinning coins?
Because finance is essentially the business of managing risk and probability.
Right.
McKinsey estimates quantum computing could create up to $230 billion annually just in the financial sector. A big part of that involves something called Monte Carlo simulations.
Right. The phrase Monte Carlo sounds like a casino, but it's a real financial tool.
Yeah.
Can you explain how that works for someone who isn't a Wall Street quant?
Think of a Monte Carlo simulation as running millions of what-if scenarios. Say a bank holds thousands of mortgages. They want to know what happens if interest rates go up, if unemployment spikes, or if housing prices crash.
All at the same time.
Exactly. A classical supercomputer has to calculate all those complex, overlapping scenarios one after another, which can take hours or even days. A quantum computer could process all those intertwined probabilities almost instantly.
Meaning a bank would know its exact risk exposure in 3 minutes instead of 3 days.
Yes.
That isn't just a convenience. That is a massive competitive advantage in a market that moves by the second. And it's not just finance either. The sources also talk about pharmaceuticals.
The impact there is arguably even more profound. Right now, discovering a new drug involves a lot of trial and error in modeling how molecules interact. It is incredibly complex because molecules are tiny quantum systems themselves.
Oh, I see.
So a quantum computer can simulate those interactions natively. The McKinsey report suggests this could reduce drug discovery timelines by 2 to 5 years. That unlocks up to $160 billion in value by drastically reducing the number of clinical trials that fail.
Curing diseases faster and saving billions in research. I mean, it's an incredible pitch. But we can't talk about massive computational power right now without bringing up the elephant in the room: artificial intelligence. The sources highlight a really interesting synergy between the AI boom and the quantum boom.
If we connect this to the bigger picture, quantum computing is increasingly viewed as the natural, necessary next step to sustain the artificial intelligence revolution.
How so?
Right now, generative AI models are growing at an astonishing rate. The data sets required to train them are becoming so incredibly vast that traditional GPUs, the chips currently powering AI, are eventually going to hit a physical wall. They simply won't have the memory or the parallel processing power to keep up.
So AI is outgrowing the very hardware that birthed it.
Essentially, yes. AI needs hardware capable of processing exponentially larger data sets simultaneously. Since quantum computers process multiple possibilities at once, the two technologies are deeply intertwined. Quantum is the hardware upgrade AI will eventually need to keep evolving.
It paints this utopian picture of the future. Trillions of dollars, curing diseases, powering limitless AI. But, and this is a massive, but we need a reality check. And for that, we turn to the trenches of the internet.
The Reddit threads.
Yes. There's a deeply fascinating thread in the Reddit investing community where an engineer issued a stark warning to anyone buying into this hype. The quote that stood out was, "Technology doesn't mean business. Research doesn't mean cash."
It is a crucial, often overlooked distinction. The Reddit user accurately points out that a successful business is, at its core, a cash generator. It provides a product or service that people pay for today.
Right.
Many of the pure-play quantum computing stocks on the market, companies whose entire existence is built around this single technology, are not businesses in that traditional sense. They operate much more like incredibly well-funded university research labs.
And when you look at the financials provided in the Motley Fool analysis, the disconnect between their valuations and the actual cash they generate is shocking. Break down some of these numbers for us because they are hard to believe.
Let's look at the trailing 12-month revenues, basically what they've actually sold in the last year, and compare that to their market caps, which is what the stock market says the company is worth. Take IonQ. They brought in about $80 million in sales, but they're sitting on an $18 billion market cap.
So they are valued at well over 200 times their actual revenue.
It gets more extreme. D-Wave Quantum has $24 million in sales, but a $10 billion market cap. Rigetti Computing, $12.7 million in sales, $8.5 billion market cap. And the most glaring example is Quantum Computing Inc.
Oh boy.
They had just $550,000 in sales over the last year.
Wait, $500,000? A successful local restaurant makes more than that in a year, yet the market is valuing them at what?
$3 billion.
That is just wild.
Yeah.
Wall Street is handing billions of dollars to companies that are essentially running high school science fairs with a corporate logo.
When you look at those numbers, the market is aggressively pricing in decades of flawless future execution. Investors are assuming these companies will cross the finish line first, completely ignoring the monumental scientific hurdles that still exist.
And that brings us to the scientific skepticism, which is arguably the most sobering part of the academic papers we reviewed. Quantum computing, at this stage, sits at the absolute outer edge of human knowledge.
This isn't just an engineering problem, like figuring out how to make a microchip a little bit smaller or a battery last longer.
No, it is a fundamental physics problem. The academic sources highlight prominent figures like Gil Khalai, a highly respected mathematician at Hebrew University. He argues that a concept called quantum error correction might actually be impossible due to the unyielding laws of physics.
Walk us through error correction. Why is that the deal breaker?
Remember those qubits we talked about, the spinning coins? They are incredibly fragile. The slightest environmental noise, a tiny fluctuation in temperature, a stray electromagnetic wave, even a vibration can cause a qubit to lose its quantum state.
And when that happens, the calculation fails.
Exactly. To build a useful quantum computer, you need millions of qubits, and you need a system that can constantly correct those errors faster than they occur. Khalai and others, like theoretical physicist Mikhail Diakonov in France, argue that the background noise of the universe will always outpace our ability to correct it.
So people are paying billions of dollars for companies that might be trying to build a machine that the laws of physics simply will not allow to work at scale. If error correction is impossible, useful quantum computing might never happen.
That reality check feels very familiar. The Motley Fool analysis drew a historical parallel that I think serves as a major warning light for anyone listening. They compared this current frenzy to the 3D printing stock bubble of 2013 and 2014.
The parallels are striking. Back then, companies like 3D Systems and Stratasys were the darlings of Wall Street.
I remember that vividly. Every magazine cover said 3D printing was the next industrial revolution. People honestly thought we'd all have 3D printers in our kitchens within 5 years, printing out our dinner plates, custom shoes, and replacement car parts.
And because of that narrative, the hype vastly outpaced the actual commercial adoption. The technology was real and it was useful for industrial prototyping, but it was nowhere near ready to be a consumer staple.
Right.
When reality set in and the timeline stretched out, the speculative bubble burst. Those heavily hyped stocks crashed by roughly 90%.
90%. That wipes out a portfolio.
The pattern is identical here. The promise of revolutionary technology drives early speculative mania. Retail investors fear missing out on the next internet, so they pour money into pure-play startups. But the timeline for commercial viability is almost always much, much longer and bumpier than the market expects.
So for you listening, if the zero-revenue pure-play startups are a dangerous 3D printing style gamble, where do you put your money if you genuinely want exposure to this tech? Analysts in our sources are saying to forget the D-Waves of the world and look at our top stock pick number 1, Microsoft.
Microsoft represents what analysts call the smart infrastructure play. They are taking a highly strategic, multifaceted approach to the quantum race, rather than betting the farm on a single piece of hardware.
What I love about their strategy is the toll booth model. They aren't just trying to build the ultimate quantum computer in a vacuum. They're selling access to other quantum companies like IonQ and Rigetti through their Azure cloud platform. So if a startup actually manages to build the winning hardware, Microsoft still wins. They become the gateway, granting the corporate world access to it.
It is a brilliant de-risking strategy. You aren't betting on who wins the race. You are investing in the track they are all running on. And while you wait for the quantum market to mature, you are holding shares in an incredibly healthy, diversified underlying business.
Let's look at their latest earnings and guidance. In Q2 of fiscal 2026, revenues hit $81.3 billion, an increase of 16.7%. Their Azure cloud infrastructure platform alone grew 39% year over year.
And their future visibility is just insane. The sources point out they have a massive $625 billion in contracted backlog.
To put that in perspective for the listener, that is guaranteed future money equal to the GDP of a small country, just sitting in their pipeline.
Yeah.
And 45% of that is tied directly to their OpenAI commitments.
From a valuation standpoint, their current PE ratio, the price-to-earnings ratio, which measures how much you pay for every dollar of profit the company makes, is around 24.3. That is significantly lower than its historical 5-year average of 33.4. It represents a rare combination of a reasonable valuation and explosive growth potential.
But to be clear, Microsoft isn't just playing the middleman. They are heavily invested in their own quantum hardware, right?
They are. They recently introduced their Majorana 1 processor, which utilizes something called topological qubits.
Topological qubits.
Without getting lost in the deep physics, the basic idea is that a topological qubit is designed to be inherently more stable and much less prone to those environmental errors we discussed earlier. They are even working directly with DARPA, the government's advanced research agency, to build a fault-tolerant prototype.
So they have the safety net of a multi-billion-dollar cloud business, but they are still swinging for the fences on the hardware side. That brings us to our second top stock pick, Alphabet, the parent company of Google. The sources refer to this as the deep pockets approach.
The reality of massive tech conglomerates is that they are fundamentally terrified of becoming the next Kodak or Blockbuster. They know what happens when you miss a technological paradigm shift. You become obsolete.
Right.
Because of that existential fear, companies like Alphabet habitually throw massive amounts of money at low-probability, multi-decade ideas.
They essentially have billions of dollars just sitting around to fund the world's most expensive science projects.
They have the best scientific talent in the world and virtually infinite resources. If it takes 5 years or if it takes 50 years for quantum computing to become commercially viable, Alphabet has the balance sheet to wait it out. They have a long history of pushing boundaries here. They were the ones who claimed to achieve quantum supremacy back in 2019 alongside NASA, performing a specific calculation in minutes that would have taken a classical supercomputer thousands of years.
Here's where it gets really interesting. When you buy Alphabet stock for its quantum potential, you aren't just buying a lab experiment. You are getting a massive, wildly profitable, global advertising and search business that protects your investment on a day-to-day basis. You can sleep at night knowing Google search is printing cash while the physicists down the hall try to bend the laws of reality.
It provides downside protection that a pure-play startup simply cannot offer. Think about the risk profile. If a pure-play quantum company hits a 5-year scientific roadblock, they run out of cash and go bankrupt, your investment goes to zero. If Alphabet hits a 5-year scientific roadblock, they just keep selling ads on YouTube, maintain their profitability, and continue quietly funding the research.
Let me play devil's advocate for a second. If having infinite money is the key, why are analysts pointing to Alphabet and not Apple or Amazon? They have deep pockets too.
It comes down to their specific focus and track record in basic scientific research. Apple is phenomenal at consumer hardware integration, and Amazon dominates logistics and cloud hosting. But Alphabet, through initiatives like Google DeepMind and their Quantum AI campus, has historically invested much heavier in fundamental, ground-up computer science and quantum physics research. They have the specific bench of talent required for this particular race.
Which perfectly sets up a question from that Reddit thread. A user asked, how do you spot a nascent Google? Basically, if nobody knows who will win the quantum hardware race, if it's some tiny startup in a garage that figures out error correction first, how do you find that trillion-dollar giant before it pops?
The short, brutal answer from the financial analysts in our sources is you don't. The risk is simply too high for a retail investor to guess correctly. It's like trying to pick the winning lottery numbers based on a hunch.
Yeah.
But there is a very practical solution for investors who want broad exposure to the sector without betting on a single horse. That brings us to our third pick, the Defiance Quantum ETF, traded under the ticker symbol QTUM.
The diversified play. For those who might not know, an ETF is an exchange-traded fund. You buy one ticker, but you are actually buying a basket of many different companies. Let's look at the stats on QTUM. It has $3.6 billion in assets under management, so it's a very healthy, sizable fund. And it has a 0.40% expense ratio.
To clarify that expense ratio for the listener, it means you're only paying $4 in management fees a year for every $1,000 you invest in the fund. It is a very reasonable cost for the diversification you get.
And what exactly is inside that basket? Because I assume it isn't just the zero-revenue startups we warned about earlier.
That is the beauty of its construction. The fund holds over 80 individual stocks, and it is heavily weighted toward established semiconductor, cooling, and software companies. We are talking about names like Micron Technology, Teradyne, and MKS Instruments.
Companies that actually make physical products and generate steady cash today.
Yes. These are companies that are actively researching quantum applications or supplying the highly specialized components needed to build these machines. But crucially, their survival does not strictly depend on quantum computing working out tomorrow. They have robust, existing businesses.
Right.
Buying this ETF gives you a front-row seat to the quantum revolution, capturing the upside if the sector booms, but with the shock absorbers of established tech revenues to protect you if progress stalls.
The sources did mention a couple of smaller competitors in the ETF space, like WisdomTree with about $25 million in assets, and GlobalX with $20 million. But with an ETF, size and liquidity matter. The Defiance Fund at $3.6 billion is definitely the heavyweight in the room. It just seems like a much safer way to bet on the whole racetrack rather than trying to pick the winning horse.
It is the most prudent way to capture the sector's growth without taking on catastrophic single-stock risk.
So we've talked about the retail investors on Reddit arguing over hype versus reality, and we've talked about the tech giants. But what is the smart money doing? Let's spend a minute on institutional adoption.
While the internet debates whether this is science fiction or reality, Wall Street is quietly and aggressively integrating this technology. The major financial institutions are not waiting around for a perfect, fault-tolerant machine to be built in 2035. They are exploring what can be done with the intermediate, noisy technology available right now.
The specific examples in the academic sources show real movement. You have Goldman Sachs, where a researcher named William Zhang is leading their quantum efforts, actively exploring those Monte Carlo risk algorithms we talked about. Citigroup is throwing strategic investment dollars at quantum software startups like 1QBit.
And this is a global arms race in the financial sector. The French banking group BNP Paribas participated in a $10 million seed round for a quantum electronics firm. Wells Fargo has been partnering with IBM and MIT on quantum research since 2019. The financial sector recognizes a fundamental truth. Whoever masters this technology first will have an insurmountable edge in trading, cryptography, and risk management.
But the biggest institutional player of all isn't a bank. It's the government. That McKinsey data highlights something truly staggering. Global government funding for quantum technology has hit an astonishing $42 billion.
That level of state-sponsored funding completely shifts the risk profile of the entire industry.
An incredibly astute Reddit user pointed out why. Because quantum computing has the theoretical potential to break modern encryption, meaning it could decrypt secure communications of bank records. It is a massive national security issue. It is an invisible high-stakes arms race, primarily between the United States and China. Because of that dynamic, this sector is going to get funded whether it turns a profit for everyday shareholders or not.
When sovereign wealth and national defense budgets step into a technological arena, the normal rules of capitalism tend to bend. The technology will be pushed forward out of sheer geopolitical necessity, which provides an enormous underlying floor of support for the industry as a whole.
So what does this all mean? We have covered a massive amount of ground today, from the dizzying $2 trillion projections to the terrifying zero-revenue balance sheets of the pure-play startups. For you, the listener, the takeaway from all these sources is loud and clear. Do not let the futuristic sci-fi allure of quantum computing blind you to basic business fundamentals.
A technological marvel, no matter how profoundly it might change the world, must still ultimately function as a business to be a good investment.
That is the core of it. The smartest minds in finance are saying to look for companies with real cash flow and massive cloud infrastructure like Microsoft or Alphabet. Or take the diversified approach with a fund like the QTUM ETF. Gambling on zero-revenue pure plays that are trading at billions of dollars on a hope and a prayer is a recipe for getting burned, just like the 3D printing crash a decade ago.
This raises an important question, one that challenges the very foundation of everything we've discussed here.
I like where this is going. Lay it on us.
We have spent a lot of time analyzing the financial risk, but what about the ultimate scientific risk? If those highly respected mathematicians and theoretical physicists are right, if correcting the environmental noise of a quantum system is inherently impossible due to the unyielding laws of physics, what happens to the trillions of dollars of projected economic value? Could quantum computing become a perpetual technology of tomorrow that never actually arrives, leaving the massive cloud giants and retail investors holding the bag on the most expensive failed science experiment in human history?
Wow. The idea that this entire sector could just be a multi-billion-dollar illusion is wild. That is definitely something for you to ponder long after this deep dive ends. Thank you so much for joining us today. Keep learning, keep questioning, and we will catch you on the next Deep Dives.